Welcome to this exam review from Birdsy, your AI-powered study partner. Be sure to like and subscribe for more videos, and don't miss what's happening in the lower corner of the screen. It could be just the thing you need to pass your exam. Let's get started.
Let's start by taking a look at what makes a mortgage risky or non-traditional. Definition and distinguishing features versus standard loans. What is a key feature that distinguishes a non-traditional mortgage from a standard mortgage? Is it A, interest-only payments, B, fixed interest rate, C, shorter loan term, or D, higher down payment? The answer is A, interest-only payments. Non-traditional mortgages often have features like interest-only payments or adjustable rates, which can increase risk compared to standard fixed-rate mortgages. Which of the following is often considered a risky feature in a mortgage? Is it A, fixed rate, B, adjustable rate, C, biweekly payments, or D, conventional loan? The answer is B, adjustable rate. Adjustable rate mortgages can lead to payment increases, making them riskier than fixed-rate loans.
Have you noticed the code in the bottom corner? Next time you're stumped, take that code to birdsy.ai for immediate help and a free study session with Birdsy, your personal AI study partner. Plus, you'll get access to hundreds of additional questions, helping you move closer to passing your exam with confidence. The next time you're feeling unsure or stuck, give it a try.
What characteristic is common in non-traditional mortgages that increases their risk? Is it A, low down payment, B, fixed monthly payments, C, balloon payments, or D, government backing? The answer is C, balloon payments. Balloon payments require a large final payment, which can be risky if the borrower cannot refinance or pay it off. A borrower chooses a mortgage with an initial low interest rate that adjusts after 5 years. What type of mortgage is this? Is it A, fixed-rate mortgage, B, interest-only mortgage, C, balloon mortgage, or D, adjustable-rate mortgage? The answer is D, adjustable-rate mortgage. This is an adjustable-rate mortgage, which starts with a low rate that adjusts periodically, increasing risk. Why might a borrower choose a non-traditional mortgage despite its risks? Is it A, to avoid all risks, B, to have lower initial payments, C, to ensure a fixed interest rate, or D, to reduce the loan term? The answer is B, to have lower initial payments. Why this question may seem a bit tricky. Borrowers might be tempted by lower initial payments or qualifying for a larger loan, despite the long-term risks. Interagency guidance and regulatory concerns about such products. What characteristic makes a mortgage non-traditional according to interagency guidance? Is it A, fixed interest rates, B, interest-only payments, C, short loan terms, or D, high down payments? The answer is B, interest-only payments. Non-traditional mortgages often include features like interest-only payments or negative amortization, which can increase risk for borrowers and lenders. Which feature is commonly associated with risky mortgage products? Is it A, fixed monthly payments, B, adjustable interest rates, C, negative amortization, or D, high credit score requirements? The answer is C, negative amortization. Negative amortization allows the loan balance to increase over time, posing significant risk to both borrowers and lenders. A borrower is considering a mortgage with an initial low interest rate that will adjust after 5 years. What regulatory concern might this raise? Is it A, potential for payment shock, B, lack of initial affordability, C. excessive down payment requirements, or D. high prepayment penalties? The answer is A. potential for payment shock. Adjustable rate mortgages can lead to payment shock if interest rates rise significantly, posing a risk to borrowers' ability to repay. Why might a lender be concerned about offering a mortgage with a balloon payment feature? Is it A. it offers predictable monthly payments, B. it requires a high credit score, C. it has a fixed interest rate, or D. it involves a large final payment? The answer is D. It involves a large final payment. Why this question may seem a bit tricky. Balloon payments can seem manageable initially, but pose a risk if borrowers cannot refinance or pay the lump sum at maturity.
Finding this exam review helpful? If you haven't already, like and subscribe for more videos that'll get you ready to pass.
Interest-only and negative amortization loans. Interest-only mortgages, structure pros cons, payment shock. What is a primary characteristic of an interest-only mortgage? Is it A. the principal is paid off first, B. only interest payments are required initially, C. it requires a balloon payment at the end, or D. the interest rate is fixed for the loan's duration? The answer is B. Only interest payments are required initially. An interest-only mortgage allows borrowers to pay only the interest for a specified period, typically resulting in lower initial payments compared to traditional mortgages. What is a potential disadvantage of an interest-only mortgage? Is it A. lower initial monthly payments, B. fixed interest rates, C. potential for payment shock, or D. immediate equity building? The answer is C. potential for payment shock. Interest-only mortgages can lead to payment shock when the interest-only period ends as payments increase to cover both principal and interest. How does an interest-only mortgage affect the loan balance during the interest-only period? Is it A. the loan balance remains unchanged, B. the loan balance decreases, C. the loan balance increases, or D. the loan balance is paid off? The answer is A. the loan balance remains unchanged. During the interest-only period, the loan balance remains unchanged because only interest is paid and no principal is reduced. A borrower with an interest-only mortgage is nearing the end of the interest-only period. What financial change should they anticipate? Is it A. a decrease in monthly payments, B. no change in monthly payments, C. a fixed interest rate adjustment, or D. an increase in monthly payments ... The answer is D. an increase in monthly payments. When the interest-only period ends, borrowers must start paying both principal and interest, leading to higher monthly payments. Why might an interest-only mortgage seem appealing to a borrower with fluctuating income? Is it A. it guarantees lower payments throughout the loan term, B. it offers lower initial payments, providing flexibility, C. it eliminates the need to pay interest, or D. it reduces the overall loan term? The answer is B. It offers lower initial payments, providing flexibility. Why this question may seem a bit tricky. Borrowers might overlook the risk of payment shock, focusing instead on the flexibility of lower initial payments during income fluctuations. Negative amortization and payment option arms. When balance grows, caps, recast. What is a key feature of a payment option arm that can lead to negative amortization? Is it A. minimum payment option, B. fixed interest rate, C. interest-only payment, or D. fully amortizing payment? The answer is A. minimum payment option. Payment option ARMs allow borrowers to choose a minimum payment that may not cover the interest, leading to negative amortization. What happens to the loan balance in a negative amortization scenario? Is it A, it decreases, B, it increases, C, it remains the same, or D, it is forgiven? The answer is B, it increases. In negative amortization, the loan balance increases because unpaid interest is added to the principal. What is a recast in the context of a payment option ARM? Is it A, a new loan application, B, an interest rate adjustment, C, recalculation of payments, or D, a loan forgiveness program? The answer is C, recalculation of payments. A recast is when the loan is recalculated to ensure it is paid off by the end of the term, often after a period of negative amortization. A borrower with a payment option ARM chooses the minimum payment option for several months. What is likely to happen to their loan balance? Is it A, the balance will decrease, B, the balance will remain the same, C, the balance will be forgiven, or D, the balance will increase? The answer is D, the balance will increase. Choosing the minimum payment option can lead to negative amortization, where unpaid interest increases the loan balance. How does a payment cap on an ARM affect negative amortization? Is it A, it prevents negative amortization, B, it can contribute to negative amortization, C, it increases the interest rate, or D, it eliminates the need for a recast? The answer is B, it can contribute to negative amortization. Why this question may seem a bit tricky. Payment caps limit how much the payment can increase, but they don't prevent negative amortization if the capped payment is less than the interest due. Balloon mortgages and hybrid instruments. Balloon loans, shorter term, lump sum at end, risk to borrower. What is a primary characteristic of a balloon mortgage? Is it A, a shorter term with a lump sum payment at the end, B, fixed monthly payments throughout the term, C, interest-only payments for the entire term, or D, no risk to the borrower? The answer is A, a shorter term with a lump sum payment at the end. A balloon mortgage typically has a shorter term with a large lump sum payment due at the end. This structure can pose a risk to borrowers who may not be able to refinance or pay the lump sum. Why might a borrower choose a balloon mortgage? Is it A, to avoid any risk, B, for lower initial monthly payments, C, to secure a longer loan term, or D, to eliminate the need for refinancing? The answer is B, for lower initial monthly payments. Borrowers might choose a balloon mortgage for lower initial payments, which can be attractive if they plan to sell or refinance before the lump sum is due. A borrower plans to sell their home in 5 years but is considering a balloon mortgage. What should they be aware of regarding the loan structure? Is it A, the loan will automatically convert to a fixed-rate mortgage, B, the interest rate will decrease over time, C, the monthly payments will increase each year, or D, a large lump sum payment will be due at the end of the term? The answer is D, a large lump sum payment will be due at the end of the term. The borrower should be aware that a balloon mortgage will require a large lump sum payment at the end of the term, which could be risky if the home doesn't sell as planned. What is a significant risk associated with balloon mortgages for borrowers? Is it A, fluctuating interest rates, B, high initial monthly payments, C, inability to pay the lump sum at the end, or D, no option to refinance? The answer is C, inability to pay the lump sum at the end. The significant risk is the borrower's inability to pay the large lump sum at the end of the term, which can lead to financial distress or foreclosure. Which statement about balloon mortgages might mislead a borrower into underestimating the risk involved? Is it A, they offer lower initial payments compared to traditional loans? B, they are suitable for short-term home ownership plans? C, the interest rate is fixed for the entire term? Or D, refinancing is always an option at the end of the term? The answer is D. Refinancing is always an option at the end of the term. Why this question may seem a bit tricky. The statement implies that refinancing is always an option, which may not be true if market conditions or personal finances change.
Finding this helpful? Hit like and subscribe so you'll be the first to see new exam prep videos on the topics you need to master, all with Birdsy, your AI-powered study partner.
Hybrid arms, step rate, and exotic layered features. What is a key characteristic of a balloon mortgage? Is it A, fixed interest rate throughout the term? B, a large final payment at the end of the term? C, no down payment required? Or D, interest-only payments throughout the term? The answer is B, a large final payment at the end of the term. A balloon mortgage typically requires a large final payment at the end of the loan term, unlike traditional mortgages with consistent payments throughout. What does the term hybrid arm refer to in mortgage lending? Is it A, a mortgage with a fixed rate for the entire term? B, a mortgage with an adjustable rate from the start? C, a mortgage that combines interest-only and principal payments? Or D, a mortgage with an initial fixed rate period followed by an adjustable rate? The answer is D, a mortgage with an initial fixed rate period followed by an adjustable rate. A hybrid arm combines features of both fixed rate and adjustable rate mortgages, starting with a fixed rate before switching to an adjustable rate. A borrower is considering a 5-1 hybrid arm. What will happen after the initial 5-year period? Is it A, the interest rate will adjust annually? B, the loan will convert to a fixed-rate mortgage? C, the borrower must pay off the remaining balance? Or D, the interest rate will remain fixed for another 5 years? The answer is A, the interest rate will adjust annually. After the initial 5-year fixed-rate period, the interest rate will adjust annually based on the index and margin specified in the loan terms. In a step-rate mortgage, what happens to the interest rate over time? Is it A, it remains constant throughout the loan term? B, it adjusts based on market conditions? C, it increases at predetermined intervals? Or D, it decreases over time as the loan balance decreases? The answer is C. It increases at predetermined intervals. Why this question may seem a bit tricky, step-rate mortgages have scheduled rate increases, which can be confused with adjustable rates that vary with market conditions. Non-qualified mortgages and Alt-A, alternative products. What are non-QM loans? Criteria, trade-offs, underwriting flex. What is a primary characteristic of a non-QM loan? Is it A, they are government-backed? B, they have flexible underwriting standards? C, they require a 20% down payment? Or D, they are only available to first-time homebuyers? The answer is B, they have flexible underwriting standards. Non-QM loans do not meet the standard criteria set by the Consumer Financial Protection Bureau for qualified mortgages, often due to flexible underwriting standards. Which of the following is a common trade-off of choosing a non-QM loan? Is it A, higher interest rates? B, lower credit score requirements? C. Guaranteed approval. Or D. No documentation needed. ... The answer is A. Higher interest rates. Non-QM loans often come with higher interest rates due to the increased risk for lenders compared to traditional QM loans. What flexibility do non-QM loans offer in terms of income verification? Is it A. No income verification required? B. Strict income verification through tax returns? C. Alternative income verification methods? Or D. Income verification through employer letters only? The answer is C. Alternative income verification methods. Non-QM loans often allow for alternative income verification methods, such as bank statements instead of traditional pay stubs or tax returns. A borrower with irregular income from freelancing is seeking a mortgage. What type of loan might best suit their needs? Is it A. Conventional loan? B. FHA loan? C. VA loan? Or D. Non-QM loan? The answer is D. Non-QM loan. Non-QM loans are suitable for borrowers with irregular income as they allow for alternative documentation like bank statements to verify income. Why might a borrower choose a non-QM loan despite higher interest rates? Is it A. To avoid any documentation requirements? B. For flexible qualification criteria? C. To secure a government-backed loan? Or D. To guarantee loan approval? The answer is B. For flexible qualification criteria. Why this question may seem a bit tricky. Borrowers might prioritize flexible qualification criteria over cost, especially if they have non-traditional income or credit profiles. Alt A, A-, weak A mortgages, and low no-doc features. What is a key characteristic of a non-qualified mortgage? Is it A. They do not meet the standard criteria for a qualified mortgage? B. They require a 20% down payment? C. They are only available to first-time homebuyers? Or D. They have a fixed interest rate? The answer is A. They do not meet the standard criteria for a qualified mortgage. Non-QM loans do not meet the standard criteria set by the Consumer Financial Protection Bureau for a qualified mortgage, often due to non-traditional income verification. Which feature is commonly associated with Alt-A mortgages? Is it A. Strict income verification? B. Less stringent documentation requirements? C. Government backing? Or D. Only available for investment properties? The answer is B. Less stringent documentation requirements. Alt-A mortgages often involve less stringent documentation requirements compared to prime loans, making them more accessible to certain borrowers. A borrower with irregular income applies for a mortgage with minimal documentation. What type of mortgage are they likely seeking? Is it A. Conventional mortgage? B. FHA loan? C. Non-qualified mortgage? Or D. VA loan? The answer is C. Non-qualified mortgage. The borrower is likely seeking a non-QM or Alt-A mortgage, which accommodates irregular income and requires less documentation. Which statement about low no-doc loans is accurate? Is it A. They require no documentation whatsoever? B. They are only available to high-income borrowers? C. They have lower interest rates due to less paperwork? Or D. They often come with higher interest rates due to increased risk? The answer is D. They often come with higher interest rates due to increased risk. Why this question may seem a bit tricky. Low no-doc loans suggest minimal documentation, but they still require some verification, often leading to higher interest rates due to increased risk. Risk assessment, red flags, and test scenarios. underwriting concerns, payment shock, documentation, debt layering, collateral-dependent loans. What is a primary concern for underwriters when assessing a loan with significant payment shock? Is it A, borrower's ability to manage increased payments? B, borrower's credit score? C, property location? Or D, interest rate fluctuations? The answer is A, borrower's ability to manage increased payments. Payment shock occurs when a borrower's new mortgage payment is significantly higher than their previous payment, raising concerns about their ability to manage the increased financial burden. Why is documentation crucial in the underwriting process? Is it A, to determine the property's market value? B, to verify the borrower's financial situation? C, to calculate the loan-to-value ratio? Or D, to assess the neighborhood's risk level? The answer is B, to verify the borrower's financial situation. Documentation provides evidence of the borrower's financial situation, helping underwriters assess risk and verify the borrower's ability to repay the loan. What does collateral-dependent mean in the context of a loan? Is it A, the loan is secured by multiple properties? B, the borrower has excellent credit? C, repayment depends on the collateral's value? Or D, the loan has a fixed interest rate? The answer is C, repayment depends on the collateral's value. A collateral-dependent loan relies heavily on the value of the collateral for repayment, often because the borrower's ability to repay is insufficient. A borrower is applying for a loan with multiple existing debts. What underwriting concern does this scenario highlight? Is it A, payment shock? B, collateral dependency? C, insufficient documentation? Or D, debt layering? The answer is D, debt layering. Debt layering is a concern when a borrower has multiple debts, as it increases the risk of default due to the cumulative financial burden. Which factor is least likely to be a red flag in underwriting a collateral-dependent loan? Is it A, overvaluation of the property? B, stable employment history of the borrower? C, high loan-to-value ratio? Or D, inadequate property insurance? The answer is B, stable employment history of the borrower. Why this question may seem a bit tricky, it requires distinguishing between factors that are typically red flags and those that are less concerning in this context. Scenarios: identifying which risky feature is present and what could go wrong. What is a common risk associated with adjustable rate mortgages? Is it A, fixed interest rates? B, payment shock? C, prepayment penalties? Or D, equity buildup? The answer is B, payment shock. ARMs can lead to payment shock if interest rates rise significantly, causing monthly payments to increase unexpectedly. Which feature of interest-only loans can pose a risk to borrowers? Is it A, fixed monthly payments? B, immediate equity gain? C, negative amortization? Or D, low initial interest rates? The answer is C, negative amortization. Interest-only loans can lead to negative amortization, where the loan balance increases over time if payments do not cover the interest. What is a potential risk of balloon payment loans? Is it A, large final payment? B, high initial interest rates? C, immediate foreclosure risk? Or D, fixed payment schedule? The answer is A, large final payment. Balloon payment loans require a large final payment, which can be difficult for borrowers to manage if they are unprepared. A borrower chooses a loan with a low initial rate that adjusts after 5 years. What risk should they be aware of? Is it A, immediate foreclosure? B. Equity loss, C. Prepayment penalties, or D. Payment shock? The answer is D. Payment shock. The borrower should be aware of the risk of payment shock, as the interest rate may increase significantly after the initial period. Why might a borrower face difficulties with a loan that has a teaser rate? Is it A. Fixed payments, B. Immediate equity gain, C. Higher payments after adjustment, or D. No risk of foreclosure? The answer is C. Higher payments after adjustment. Why this question may seem a bit tricky. Teaser rates are initially low, but can lead to higher payments once the rate adjusts, which may not be obvious at first.
Thanks for watching. If you found this exam review helpful, be sure to subscribe for more real-world practice and topic-focused study videos. And visit Birdsy.ai to start your free trial of Birdsy, your AI-powered study partner.